And good evening. This is the Elliott wave update for the S&P 500 for Wednesday, February the 9th, 2022. Well, the bullishness continued today, and the market in the S&P got all the way up to 45.85 before retreating just into the close. I did watch the close, and I found it very interesting. Reminded me of my days when I was on a trading floor, and you had people coming in at those last few seconds attempting to put their mark on the close of the futures. And it seemed to do that again today, so I was a little bit amused. I want to make very clear now that I am not married to either side, to a bullish or a bearish picture. I present what I believe to be an accurate depiction of what I see happening in the market, what the market is telling me. And so when I see that this is coming up, I've received a couple of comments and some phone calls and some emails about my bearish position. And I want to make clear, I am not bearish. I am not bullish. I am going to do what the market does each day. I am going to come in and trade without a bearish or a bullish posture and trade the price action in front of me. What I'm attempting to do here is to take my interpretation of what I believe the Elliott count is, and then relate that to what we can expect for tomorrow, both to the upside and to the downside. So I try to give a two-sided view. And within that, I try to just include what we should see if the market begins to break to these levels, or if the market is going to start to break down, what we should be expecting. As I left it yesterday with the S&P, I had talked about the position within the moving averages. Well, today's additional bullishness really cleared up that picture. As you can see, here we are on the hourly chart, and it's the 200, the 50, the 20, the 8, the 4, they're all pointing up. And that does leave a very bullish and a positive tone in the market. But we have to also consider that the reason it has gotten here is the last 2 days, we've seen some very substantial gains in the marketplace. And I'm not attaching a bullish or a bearish posture onto either of yesterday's or today's strong gains. What that does represent to me is the possibility that on that second Tuesday of a month, the 401k money and the IRA money has now been transferred over and is now being over to the fund managers and to the hedge fund managers and portfolio traders, and they now have to put that to work. It's been allocated to particular funds, to particular ETFs, to particular stocks. And then that gets put into the market. That produces the picture that we're getting. Now, it kind of can be a little bit puzzling because everybody's being attached to the bullish picture and nobody's realizing it's like we still have the reality that will confront us and confront the market. And that reality is, how do we want to handle, how does the Federal Reserve want to handle inflation? We cannot deny its existence. You can try to deny its existence, and then you're just going to end up spending way more money than you think you should be spending, or get angry as prices continue to go up. If we accept its existence, and then we are going to be able to be open to deal with it. And that might just be that the Fed is going to raise rates. Now, what I found interesting today is that the bullish tone got a little bit of a boost when one of the Fed governors, not sure which one or where they're located, came out and said they did not see a compelling reason for the Fed to boost rates in the March meeting a half a point. It's like, okay, well, if the market wants to take that in, it's like their inability to deal with inflation does not mean we return to bullish. It doesn't change the reality that inflation is real. We're seeing it at the gas pump. We're seeing it at our natural gas prices, which, whether we want to accept it or not, have gone up substantially. We're seeing it at the grocery store. We're seeing it in the products that we buy. We're seeing inflation hit us in wages. There's wage inflation. People need to get back to work, and they want jobs that are at least going to be able to help them pay for what they need. So there are a lot of things that go into what is going on that forces a market to get back into reality. I cannot discount enough that I trade what's in front of me. I do not take a bullish or bearish posture. So today, I had a very profitable day. I traded the upside. I traded the downside. Whatever the market was doing, if it met my requirements for a particular trade and broke certain levels, boom, I got into a trade. But I also had my exits, and I also had where the trade would be invalidated. So I was able to go in and trade each day, fresh, open, and to whatever the market wants to do. Now, I can wrap parameters around that by giving where the next moving average might come in, where the value area high is, where the point of control is, where Fibonacci resistance comes in, or support. All of those factor into how we trade during the day. And that is where I'm going to be coming from today. Now, back to our chart. Today, the market again got very close to that 45.85 number. 86 actually is the level. Now, to be honest with you, what would happen is that, and I have spoken about this before, that the possibility is that this C wave is not complete. And then if that's the case, check this. I can count 3 waves up, or I can count 5 waves up. But if 3 subdivided more than I was actually noticing, then the 3 is here. This 3 waves down is the 4th wave of C. And this is wave 1 of 5, 2 of 5, 3 of 5, little return back down is in a 4 of 5, and then we're up into this next zone. That's why that zone is there. It doesn't mean that I'm wrong. It doesn't mean that it's anything other than the market telling me if they're not done. And so what are the next possibilities and capabilities for that market, for the S&P? And it's very likely that we could break 45.86. And they might do that overnight. As the Asian markets open and the European markets open, they may pick and just have to trade the bullishness that we left the market with. And maybe they'll see it in their own markets. And so we could end up here, up here, up here, or even up here before all is said and done. Now, if that's where the market wants to go up additional 100 points from here, so be it, let them do it. But let's not forget that tomorrow morning, pre-opening, we have the CPI report, Consumer Price Index. That's either going to show less inflation or more inflation. We also have the jobless claims. That's going to show how people are either not getting back to work or they are going back to work. And so more people employed, that's not deflationary, that's inflationary. And they're going to be looking for, they need more money because they have to pay their own bills. So there's several things that we need to just put into place and not just this bullish tone that the market is leaving us with. For all intents and purposes, I am waiting, but I'll tell you what, I will trade the rally. I absolutely will trade the rally, and I'll trade the decline, and I won't care why it's going up or down. And that's the mindset. And that's something else that I want to just re-emphasize today. When we come into trade, we wrap things around this outside noise about, oh, you're wrong here, or what happens if it breaks, it's very bullish. The market can be very bullish and it can be very bearish, all within the same 5-minute period or 15-minute period or an hourly period. So to wrap myself around that is just presenting outside noise. And now I'm missing seeing the individual moves, seeing the moving averages fall into position. Now, this is the 4-hour chart. This one is not in alignment. The 200 is sitting up here. The 4 has broken above it. The 8 hasn't. This is the 4-hour chart. So that's the next chart that needs to get in alignment to continue this bullish picture. Okay. So again, technically, is how I trade the market. Technically, this market can turn on its heels, come flying down, That 200 stays right where it is, starts to turn lower. These all start to head lower. And then once again, they start to break down below the 20, below the 50, and then everything is going to be in alignment to go back down as quickly as it got into alignment to go up. So in other words, a 4-hour chart, give us a day and a half, and it can be all the way taken away. And I can't tell you what could cause that. Just like I couldn't tell you what would cause the bullishness in the market. I have an idea, but why does suddenly people are going to turn bullish? I don't know. We'll have to find them, and then to pull all those people takes way too much time. I'd rather just trade, and I'll trade the moves. So my mindset tries to block out that external noise, and quite frequently, that internal noise can come from within me, so within yourselves, that'll take away your focus. And if you miss your focus, you're going to miss your entry, you're going to miss your exit. A lot of things just suddenly don't make sense. And then maybe you're short and the market's moving against you. You've got to stay focused, because you have to realize where is that trade invalidated for the reason that I got short. And that makes the difference. The difference also can be, I'm not buying or selling based on what somebody else does. I'm buying or selling based on my signals, based on my vision, based on what I see the price action doing, and what I know happens when certain moving averages get taken out, get crossed either to the upside or crossed to the downside. You have to, when you learn these, then you know what these reactions are going to be. I'm not basing it on something that I heard on CNBC or something. I don't listen to CNBC, but I think you get the gist of what I'm saying. So back to what we can expect for tomorrow. I'm going to be very open and say, I honestly find it more difficult to try to say what we can expect. If it breaks above 45.85 and then heads above 45.89, which is all the way up here, then I am going to assume that the market is heading to the next resistance at 46.12. And if it breaks that, the zone actually is 46.12 to 46.21. If it breaks that, then I'm going to assume that it's going to get up to 46.50, et cetera, et cetera. So for this thing to prove it's bullish and we're heading to new highs, it has to break that level. And then that would change the overall longer term count. But right now, my focus is on where does this 2 end, possibly, and how high will the market go? Well, here are my points. I'm leaving them in place. I can probably add an additional, but I have no points in which to put it in, because this is not a 5-wave structure. This is definitely a 3, but this is not 5. So I can't say this is 1, 2, 3, 4, and we're now in a much larger 5th wave up, because it doesn't fit. And so that is another factor that I put in, which leaves in my mind that this will remain 3 waves up, an A, a B, and a C. Now, whether that C wave is definitely complete here or whether it's going to complete up here, it doesn't really make a difference in the larger picture. If it ends up here, I'm still going to trade it. I'm still going to trade it higher. I'm going to follow what the market and the price action are telling me. Why would I want to fight that? Why am I going to say, well, I think that's over, so I'm going to short it? That's a recipe for disaster. Unless you've got very, very, very deep pockets, I don't recommend doing that. So this is my point. Trade the price action. Trade what the moving averages are revealing to you. Trade what the Elliott count is. Trade what the potential for an expansion of that count calls for. Do not assume a bullish or bearish posture, because I don't believe that assists you in trading the market. If I'm going to just be nothing but bullish, what happens when the market turns and comes down 40 or 50 points? And you're long, and maybe you're going to stay long, but when I'm trading, have an idea like why you're getting into the trade, what your target is to get out of the trade, and what your point where the trade will be invalidated and your reason for being long or short is invalidated, that's your exit point. And then you live to trade another day. So for tomorrow, I believe that the potential is strong. We're a little bit overextended. Doesn't mean it's going to stop. So overnight, we may see the market get back above and go above 86, get up to 89, maybe even get up to 4,600. Those are all very possible and not out of the realm of reality. Then we're going to have to wait. We get those CPI numbers and the jobless claims before the market opens tomorrow. That will absolutely determine direction. If these are accepted by the market and just absolutely find them to be bullish, then I would suspect that this thing is going to get up at least 40 or 50 points easily. And it'll be up likely here before we even wake up and get our computers open tomorrow morning. So unless you're up that early and you're going to sit there and watch these figures, if they are totally wrapped around the market and the market just thinks Fed's not going to do nothing, they're not even going to raise in March, this is all a folly, boom, trade on it. And the market will. So follow the market without having to have a reason as to why it's going up, why it's going down, or why it's going sideways. That is the catch. That's noise. Just trade the price action, trade what's in front of you, and make your money. So we do have potential where we can go up. We have certainly potential to get above 45.86, get above 45.90, and start heading up to 4,600. These are the zones: 46.89 to 49, 46, 45.89 to 90. Then we have 4,600, 46.13 to 46.21. Then we have 46.50. Then we have 46.86. And that likely we could put a zone up to 4,700. That's the picture. If the market starts to break down, again, I'm going to open this up a little bit, you're going to see it pop below these moving averages. If it breaks that 20, which right now is sitting just below 45.53, if it breaks below that, expect some acceleration. If it breaks below the support, expect acceleration. If it breaks below 45.28, expect acceleration. And if it does it all in one big move, it's going to be killer. It's going to be, they are just looking for bids and they will hit whatever is there. So, and if it breaks below the hourly 200, don't get in the way. We will see massive acceleration if this market begins to tumble out. Now, have we seen the NASDAQ go down 100 points in a day? We most certainly have. Has all of this bullishness will be wiped out? It certainly can. Have I seen the Dow gone down 700, 800, 1,000 points in a day? Yes, we have. Have we seen the NASDAQ go down 500 or 600 points in a day? Yes, I just asked you to go back a week or so. We had it. And then we got this. The day before, actually the trading day before Amazon reported, the market touched 44.38. And then afterwards ended up at, actually it's this one. Maybe it was here, excuse me. But whatever that day was, the market turned and rallied. But prior, the market was down at one point over 600 points. Facebook's earnings, et cetera, that all came in. So these things can happen. A market turns bullish and bearish at the drop of a hat, and that can happen again. So trade smart. Trade according to what you see the price action doing. Trade according to what the moving averages are beginning to tell you, upside or downside. An upside move, the 4 and the 8 are going to walk it up. And that's going to be your ticket for when this might be over. If it starts to break here, then you're looking to come here. If it starts to break there, you might want to take a position and look for it to come down to here. That's where I'm going to leave it. The next update will be Thursday, February the 10th.